Hello, my name is Joe Hoyle, speaking to you from the University of Richmond and the co-author of your financial accounting textbook. Here today we're going to introduce Chapter 10. That means that you're over halfway through the textbook, which also probably means that you're over halfway through your financial accounting course. If you have a moment, go back and look at what you've already covered in this book. I think you'll be very pleased by how much you have learned. It comes gradually. Learning often does. But now you could go on the internet and look at a set of financial statements, and you would be surprised by how much you would understand. We've discussed generally accepted accounting principles, financial statements, accounts receivable, inventory, and the like. Now we're going to look in Chapter 10 at property and equipment. The first question is, what exactly qualifies on a set of financial statements as property and equipment? Property and equipment is an asset that's a tangible asset. It has physical presence. In addition, it has a life of over 1 year and it's used to generate revenue. Therefore, a machine, a building, land, equipment, all of those qualify as property and equipment. They're tangible, their life is over 1 year, and they're used by an organization to generate revenue. When we began coverage of inventory, we stressed that historic cost is the beginning process for most assets. And at that time we defined historic cost for inventory as every cost that's normal and necessary to get the asset into position and condition to sell, because that is the purpose of inventory, to be sold. For property and equipment, our definition is slightly different. It is all of the normal and necessary cost necessary to get the item into position and condition to be used to generate revenue. The purpose is slightly different, but the definition is clearly very similar. Often the question arises, why do we not record property and equipment at fair value? If you look at a piece of property, why do you not record on the balance sheet its fair value? Well, there is a couple of reasons for that. First, the asset was not bought for resale purposes. Therefore, the fair value is really not relevant to current decision making. If you have a building that you don't plan to sell, why do you need to know the fair value? What good is that to decision making? In addition, fair value is so subjective that it is very difficult to come up with one clear-cut number to be used. 3 or 4 different experts would easily come up with 3 or 4 different fair values. Therefore, in financial accounting for property and equipment, for the most part, we stick to being based on historic cost. In an earlier chapter, we discussed the matching principle that says that expenses should be recognized in the same period as the revenues they help to generate. That raises the question on recording expenses for property and equipment. All property and equipment except land and a few other assets with infinite lives have to be depreciated. That means that their cost is assigned to expense over the life of the asset. That depreciation process has to be a rational allocation of that cost. As we discuss in Chapter 10, there are several methods that are used to assign cost to the period. Depreciation is a cost assignment. That's what its purpose is. One way we'll introduce you to is the straight line method, which assigns an equal cost to each time period. We will also indicate that you can use accelerated depreciation methods such as double declining balance. In those methods, higher expenses recorded in the earlier time periods. We also show you the units of production method, another way to record depreciation that assigns depreciation based upon usage. Although those methods can and are used in the business world, they record a depreciation expense each period, and they reduce the cost of the asset to a lower book value. That book value is the historic cost that was paid to acquire the asset, less all accumulated depreciation that has already been sent to expense up until the current time. We also introduce wasting assets, such as a gold mine or an oil well, where the asset is actually used up by the process. We do not record that as depreciation. We call that process depletion. And depletion is done exactly like the units of production method. We assign a cost to each unit that is removed from the asset, and we record the cost based upon that process. That is applicable if you have a wasting asset. It is not unusual in a business to exchange or trade assets. Vehicles, for example, are frequently exchanged to get new vehicles. What is the cost of those transactions? That's not a case where you're simply paying cash. How is an exchange recorded? Exchanges are recorded by taking the old book value of the asset that you give up off the books. You then record the fair value for the asset that you receive. It's a simple process. Book value for old asset off, fair value for new asset on. The difference in those two figures is recorded as a gain or as a loss. But there's one key element there. What fair value do you use? Well, accounting is cost-based. So therefore, the cost is what you sacrifice. To get the new asset, you give up the old asset. For that reason, you record the new asset at the fair value of the asset that you give up. Most people think it's the fair value of the asset that you get, but that's not cost. Cost is that you record the fair value of the new asset equal to the fair value of the asset that you gave up or surrendered. So in an exchange, take off the book value of the old asset, put on fair value for the new asset, and the fair value is the fair value of the asset that you surrendered. The difference then is a gain or loss. If you do not know the fair value of the asset you gave up, then, and only then, you use the fair value of the asset you received. Now, if you go back to inventory, remember that we recorded inventory at the lower of cost or market. Recording assets at that lower figure indicated that something had happened to the inventory so that it was not as worth as much as we had hoped. With property and equipment, you do somewhat the same thing, but it's called an impairment. An asset of property and equipment is impaired if you cannot get enough cash to at least equal the current book value. So if the book value today is $25,000, but that asset will not generate $25,000 in cash in its entire remaining life, then the asset is viewed as impaired. If that occurs, then you write the asset down from its book value to its fair value. So we do occasionally record assets at fair value, but that's when they are impaired. A lot of companies have a lot of assets, and some of those assets are almost guaranteed to become impaired. If you can't get cash that will cover the book value, it's impaired and you have to record fair value. And finally, assets are held a long time. A building might be held for 30 or 40 years, for example. What happens when you later spend money on that asset? Do you record that as another asset, or do you record that as an expense? In my classes here at the university, I tell my students, If you spend money later on an asset and it makes it bigger or better or more efficient in some ways than you had originally anticipated, then that cost is capitalized, added to the cost or added to the book value of the property and equipment. If the expenditure does not make it bigger or better or more efficient in some way that you had not anticipated, then you expense it. That gives you a rule to go by for those later expenditures. Chapter 10 covers a wide range of topics dealing with property and equipment. Read it carefully, look for the things that we have talked about, and start gaining the knowledge that you need to be a wise decision maker.